Margy, why are bonds different than any other kind of budget process, and how we get money to spend for things?
Well, bonds are a way of borrowing money to pay for things we want in the future. And the state borrows money, usually long-term, up to 30 years, for buildings, for roadways, for bridges, long-term projects. They don't have the money now, so they need to borrow it from the taxpayers, and they have to pay back interest. Sort of like if you want to buy a house, you borrow some money because you don't have it in your savings account, and then you pay it back with interest. Some of the issues with bonds are that you commit the state to pay a lot of money over time. Just as taking out a mortgage for your house, if you look at what you pay over 30 years to pay back that mortgage, you almost pay back double what you borrow, right. And that's what happens with the state. It's almost a 2-to-1, the amount of money that they borrow. This year, there's $16 billion in new borrowing on 4 ballot propositions. So paid back over time, that's $32 billion.
$32 billion.
And right now, the state has $53 billion on track that they have already borrowed, that they're paying interest on, and they have more for other projects that haven't started yet, but that will add to. What happens is it takes money away from your spending, because you have to pay that mortgage payment each month. You have to pay that credit card debt. The state has to pay back every month the interest payment on these bonds, and it cuts into the money they have for other programs.
And you talked about 52 million.
Billion,
excuse me.
Yeah, big
52
money.
billion.
Yeah.
That's already, those are bonds that have been sold.
Those are bonds that have been sold, yes, and we have another $68 billion that for other projects that's been authorized, but we haven't sold the bonds yet.
And
right.
now there's another $16 billion on this ballot.
On the ballot proposition. But I want to back up a little bit and talk about the state of California and our borrowing. We have the second lowest bond rating in the country. Only Louisiana is lower than ours.
Have the top.
I know, it's very sad. But the rating agencies look at our struggles to balance the budget every year, and they say, this is a concern. We're not sure you can pay this back. And so the lower your debt rating, just like a subprime mortgage, you pay a higher interest rate, and that costs the taxpayers.
Right.
When you have
the bonds have first priority in the budget.
Well, the general obligation bonds, which all of these ballot measures are related to, it's based on the taxing authority of our state government. However, think how hard it is to raise taxes in this state. So, for example, the amount of debt that we have, it's how we are able to service that, the ratio of the overall budget with how much we have to pay towards that debt. And it's bounced between 3% and 6%, which is a percentage of your budget. Doesn't sound like a whole lot of money, but right now we're at 5.4%. We're scaling up towards the higher end. If we pass these ballot measures, we'd be over 6%. So 6% of the budget, again, doesn't sound like that much money, but I wanted to give you a couple of examples of our government that are less than 6%. For example, the whole legislative, judicial, and executive portion of the budget is 4.5%. The entire general government is 5.5%. So we'd be spending more than that just to pay back,
to service
the debt on these
bonds.
The bonds
have any idea of how enormous that debt is.
No, and one of the measures that I think is a little bit unfortunate, how some of the proponents of these measures will say, no new taxes. Well, guess what? No new taxes, but less money for the government to spend on all the other programs that you want the money to go towards.
So the percentage of the 5% now,
right?
Does that include the 68 million that have been authorized but not sold?
No.
It doesn't?
No.
Right.
So that could grow over time.
So that could grow a lot.
Plus, if we continue to have struggles with balancing the budget, if we can't get a higher credit rating, we continue to have to pay more than other states for this, and that perpetuates the problem. And given the current economic situation that we're in now, the whole notion of borrowing more money and having to pay more money to pay it back because of concerns about our credit rating are very big issues.
Margy, could you consider the pensions that are promised for public employees another kind of debt that they've been promised?
The liability is huge. It's really huge. And in private industry, you don't find pension plans anymore. People are having to put money into their own individual accounts, IRAs and 401ks. Yeah, that's a huge liability.
Right.
Yeah.
You know, there was a point made the other day, we were talking about bond financing. It was, another point was that when these bonds are sold, they're municipal bonds, and therefore they're tax-free
Right.
to the investor.
Right.
So the state is paying out interest money to the investor in those bonds, but the investor in those bonds doesn't have to pay any income tax.
So it's actually a loss of revenue.
So it's a loss of revenue
to
also.
the state and to the federal. The other part of that is that our budgeting process is based on expected tax revenues over time. Generally speaking, as your population grows, as people's incomes grow, they have more money that they earn and they pay taxes on. You get into an economic situation where things are not so good, people are not making as much money, they pay less taxes, and the state has less revenue. But you've committed yourself with bonds on a 30-year note.
Right.
You don't get to say, well, gosh, I made less money this year, can I pay less interest? It doesn't work that way.
So when people are evaluating the 4 bond issues that are on the ballot, should they be looking at, well, first of all, I suppose, what they're for?
Sure.
Give us some points on how people should look at a bond
I think
issue.
part of it is sort of your attitude. Should government be there to spend money on the things that you really wanted to spend and figure out some way, whether they have to increase taxes or, which is always, that's what a general obligation bond means, that the state can raise taxes if they need to cover their bills. I think you need to look at what the issues are, whether they're important to you. I think you need to look at what is already in place, and is that covering it? And I think you need to look at the health of the state overall. I mean, if it was your budget, would you put that money towards it, or would you say maybe not this time?
I think too it's important that things be, in other words, it's like us buying a house and assuming a mortgage.
Yeah.
You don't want to assume a 30-year mortgage in order to buy a new TV set.
Right, exactly. Credit card debt is an example of.
So you want to be investing in something that's
you want there for the long
infrastructure,
term.
or public lands,
And that was that's what bonds were initially intended to pay for, is long-term capital projects that would generate something back in return for the taxpayers than sort of social service types programs.
I don't think the voters understand how the legislature's hands are tied, how little wiggle room they have because of other initiatives like Prop 98, which commits almost half of the budget to the funding of the schools. So when it comes time to look at the budget, some of it is just all built in, and they have very little choice about other kinds of programs.
I think we need to look at the state's money as our money, and would you really want to be spending your money on some of these things? Would you want to lock yourself into that kind of a commitment over a long period of time?
And have no options when the time comes.
Right, or options that are going to come back to haunt us that would be increased taxes or not money for some of the programs that we do want to support.
Okay, well, thanks, Margie.
Yeah.
That was great.
That's good.
Thanks.